My name is Pat O'Connor, and this is video number 19 from my National Mortgage Exam tutorial series. Before we get started, I want to mention that the material for this tutorial is taken from the study guide that I have published on Amazon. It's updated every year, hundreds of questions and answers, 2 final practice exams, and it is available in both Kindle and paperback format. Also, if you watch the video till the end and you are a subscriber, you can request the download link to a quiz. And there'll be more information about how to do that at the end of this video. All right, let's get started. This is part 1 of the mortgage loan origination activities section. And I'm going to start with the loan inquiry process and what you as a loan originator should be prepared to ask either someone who wants to borrow, wants to get a loan immediately, or someone who's just looking to see what they need to do so they're ready in a year from now. They know they're not ready now, but they're planning ahead for a year. So first, ask them, why are you getting a loan? Is it a purchase loan, refinance loan, a reverse mortgage? Maybe your company is not FHA approved and you don't do reverse mortgages. All right. Home equity line of credit or a second mortgage. So those are some of the possibilities. Don't just assume as they're talking that they're talking about a purchase mortgage. Just get it straight from the beginning. Also, are they a vet? Because if they are a veteran, either honorably discharged, retired, or current military, the VA loan is probably the best loan for them if they don't already have an outstanding VA loan. FHA is a good loan for individuals with lower credit scores. They have a low down payment requirements. So that may be good. You could ask them. If you're a casual conversation, you're not going to just whip out a credit report out of thin air. Ask them, hey, buddy, do you know what your credit score is? And they say, yeah, it's bad. They may go ahead and say things like, just went through a foreclosure last year. All right, that's a red flag. They're probably going to have to wait 2 years or more to get another loan. It's going to be on their credit report for 7 years. So if they just got a foreclosure, their credit's going to be dinged significantly. And so you're probably going to have to counsel them to wait. If they live in a rural area, USDA loan may be the best bet. I read somewhere, I've never done one, I read somewhere that it's available to people who could not obtain another loan. But it's great, 100% financing, very similar to VA, but there's no military requirement. Conventional loan. If it's an investment property, it has to be a conventional loan. The government insured and the government guaranteed loans, FHA, VA, USDA, do not do investment properties. So if they tell you investment, I want to either buy it and flip it or buy it and lease it out, then, no more discussion on loan product is needed. It's going to be conventional, and then you have to drill down and see if they're going to qualify for that. All right, type of property, again, primary, second home, or investment. So FHA and VA aren't going to do the second homes either. So those two are also going to be conventional. And I know I've had people call me, I'm in Florida, and they've called me all excited They just got approved by the FHA, and they want to buy a small vacation home in Florida. And they are crestfallen when I have to tell them FHA doesn't do, vacation homes. So I don't know what their loan originator was thinking about. Maybe the loan originator didn't ask them what type of product you're going to buy, and then went through the whole approval process thinking maybe it was a primary residence. Okay, so be sure you ask. Income and debt, again, you can ask them, what's your annual income? If they are just testing the waters here to see what's going to happen down the road, you may calculate the ratios for them and then say, well, you're going to need to lower your debt. We'll talk more about this in the next video. But if they're there to apply, you want them to bring documentation. All right. You want them to bring tax records, and I'll go over a little bit more of that. But if they're just want to get an overview, just kind of tell them, we want 28% of your income to be able to pay the mortgage payments. That would be the front end ratio. All right. Do you want adjustable rate or fixed rate? So part of that depends on how long do you plan on staying in the home. If short-term adjustable rates are lower than 30-year or 15-year fixed rate, and maybe they're a military family there on a 3-year assignment, maybe a 4 or 5-year ARM would be a better bet for them than a 15 or a 30-year conventional loan or fixed rate loan, right? Maybe they're flippers. Maybe they think that they can get the house, fixed up and sold within a year. If there's a 1-year ARM available, pretty darn sure it's going to be lower than the conventional rate. And then, it may go up 2%, 3% after that. So, but if they think that, I can get everything done in a year, that would be great. So that would be the product for them. And if they're flipping, it means it's going to be a conventional ARM. All right. Ask them if they have enough savings in the bank. We're going to talk about this for a little bit. They're going to need money unless they have a gift for down payment and closing costs. All right. And if they are, a marginal kind of applicant, low credit score, maybe a sketchier employment history, they moved around a lot, they really didn't stay in one job for too long, then maybe having a lot of money in the bank would be what's known as a compensating factor. All right, it can make up for not being the pristine type of borrower that everyone would like to have walk into their office. All right. Employment history. Lenders do tend to want 2 years full-time history. If you have moved and you are in a similar job, then that shows continuity. If you change careers, then that may need an explanatory letter to accompany the application. And that's another thing, I'll just throw that in because I may forget it in the later videos. If the borrower has some kind of extenuating circumstances, Have the borrower write a letter for the underwriter to read. Yes, I changed my job, but I got a promotion and I went from a salesperson to vice president of this corporation. And even though I took a little drop in pay, my future bonuses and advancement will make up for it. Or, I had trouble, my credit score is low because I have medical issues, got hit by a car, had to pay my bills, couldn't pay my Bank of America credit card. And at that point, you would have them provide hospital bills, provide proof that they were in fact hospitalized. Okay, underwriter's not going to take their word for it. There's a lot of fraud going on in mortgage world. All right, so be able to prove whatever you say are extenuating circumstances, and an individual will read them. All right, that's part of the underwriter's job. All right, questions. Covered part of this in the COA. I actually had someone sent me an email telling me the COA video was their favorite because I was laughing in part of it, and so they laughed along with me. So I think the question that I said in the COA was, if the woman looks a little chunky, don't ask her if she's pregnant. Okay? Don't ask if they plan, if a couple come into you, if they plan on having a family. You can ask them if they have kids now, but you can't ask them about future family requirements. Don't ask if they are disabled or ill. You might be able to see they're walking in on crutches, but don't ask, do you have one of these chronic diseases? You're going to be obligated if they volunteer negative things. You're in fact obligated to let the lender know. It may blow the deal, but you were still obligated, right? Because that loan may go quickly into default if medical bills escalate and they can't pay them. Marital status, this is a good, exam question. On the application, there are only 3 boxes to check. Are you married, unmarried, or separated? You cannot ask them if they are widowed. You can't ask them if they're divorced. And you can't ask them if they're single. Hey, good looking. Single? You can't. So the only 3 questions are married, unmarried, or separated. Gift donations. So Fannie Mae does allow gift donations, but not for investment properties. Okay, the borrower has to be living in the property. Acceptable donors include relatives, the spouse, a child, or any other blood relative, other individuals related by marriage, adoption, or legal guardianship, a fiance or domestic partner. The donation can go to pay closing costs, down payment. If it's going towards a down payment, they have to be cohabitating for the past 12 months. Not sure that's true if they're engaged. Could be. That part I'm not sure of. The borrower has to submit a donor letter that says the amount of the donation, at what day it was transferred to the borrower's account. The donor has to state that the gift does not have to be repaid. And it has to include the donor's name, address, phone number, and relationship to borrower. All right. So now we're going to get to the borrower application, although we're going to do more detail on this next week. But if they're going to come to you and they're going to talk about, I'd like to apply for a loan now. Maybe I want a pre-approval. Ask them to bring with them past month of pay stubs, 2 months of bank statements, and 2 years of income tax returns and corporate returns if they're self-employed and they have a corporation. And if they don't have a corporation, then proof of their self-employed income. So then once you get the application and you have the loan type, is it a 30-year fixed rate conventional? You can tell them this is going to be the interest rate, right? At that point, you can pull up a preliminary loan estimate. You're typing all this information in the computer, and then you pull it up. It's automatically generated based on the template that you filled out. And you can say, okay, based on this, your monthly principal and interest will be $2,000 a month. Oh no, that's too much for us. What can we do to lower that amount? Okay, so this is where you need to know, the business. They can lower the amount by increasing the down payment. Right, that's the easiest way. Because the more money they put down, for one thing, the less it has to be financed. So that's going to reduce the payment right there. Also, if they put down at least 20% on a personal residence, they're not going to be paying the mortgage insurance. All right, so they can eliminate that. And so that will lower the monthly P&I, principal and interest payment. So if you can get them to that and it's still not low enough for them, then maybe they had wanted a 15-year mortgage because they don't like paying all that interest. Well, if they do a 30-year mortgage and spread the payments out, twice as many months, the overall, 30-year payments, yes, it's going to be more, but typically what impacts people the most is their monthly budget. And that's going to be the principal and interest part of this, not the lifetime payout. So the principal and interest on a 30-year loan will be lower than on a 15-year loan, as long as, interest rates work out that way. Okay, but you're spreading it out. Discount points. They can purchase discount points and it will lower the interest rate. Each discount point will lower the interest rate by 1/8 to 1/4%. You can also do same things if they're having trouble qualifying. Not just because they want to lower their monthly principal and interest, but they may have to lower the principal and interest to get the loan in the first place. All right, so these are also things that they can do. Now, if they don't want to spend as much money for closing costs, they want to keep more of their cash, then you can suggest lenders concessions. So for a higher interest rate, the lender would agree to pay either all or part of their closing costs. So they're not out of pocket as much right now at the closing table. And down the road, they can always refinance into another loan and perhaps lower that interest rate that they are now agreeing to have, because the seller, the lender will pay part of the closing costs. All right, so that we also discussed that. I think it was a couple weeks ago. All right, so you have the application, and you're going to have the borrower sign the application. You're going to collect all the documentation that they bring in. And while they are sitting there, you will print out the 3-day required disclosures that have to give them at the point of time when the application is completed. So we're going to go into disclosures and the timing of disclosures next week, but you're not going to mail them out when you have everything right there on your computer that you can print out and boom, typically. Or you may have, maybe your office policy is, okay, we will email them to you. So, we're in a hurry. We want to move on to the next client. Or you're in a hurry. All right, we'll email you these things. Just follow what the office policy is. All right, verification. It depends. This also depends on the office policy. Sometimes the verification for certain items will be done by a loan processor. And all the follow-ups, hey, we don't have, this signed blah, blah, blah from you yet, or we're still waiting on your pay stubs and, that kind of stuff. Sometimes a loan processor will do it. And you may or may not share part of your commission with them for doing this. Or you may be the one doing all of the paperwork and all of the follow-up yourself. So it depends on the office. So the follow-ups are, you need to get their authorization for you to request the transcript of their tax returns. Because believe it or not, sometimes people forge those. And so the lenders want to see it from the IRS. And the underwriter, the loan processor, whoever is going to actually request it and send it along to the underwriter, or the underwriter is going to request it. But you need the permission here. So it's called the IRS 4506-T. And that allows one of the parties to get the original copy. You need to verify the deposits because the bank statements could be forged. So this is called a VOD, verification of deposit. All right, and that will go to their banks. They will give you the account number, bank name and account number, and either you or the loan processor is going to send that in to get the verification. Verification of employment, VOE. That will also be sent to the employer that is listed on the application. And that either the loan processor or the loan originator may follow that up with a phone call. Perhaps they aren't quite so quick to respond to the VOE request. All right. Reserve requirements. In the guidelines, that the outline for the national exam, they say for this item that you should know the percent of bank account assets attributable to the loan. I don't understand that question. There's no percentage involved. What there is there is an amount of money, perhaps for assets that can be liquidated, that the lender would like to see, so that the chances of immediately missing a mortgage payment are decreased. So conventional loan for a primary residence, 2 months is probably the standard. 2 months of principal and interest payments in the bank, or even PITI, principal, interest, taxes, and insurance in the bank. So it could be maybe 6 months depending on other things in the application. Jumbo loans, the big loans, may require more than that. You're buying multi-million-dollar homes. They may want to see a lot more in the bank than 2 months of, payments. Vacation homes for conventional, 3 to 4 months. Investment properties, 6 months. VA loans, 1 to 2 units, no reserves are required. 3 to 4 units, 6 months. FHA loans, 1 to 2 units, no reserves needed. 3 to 4 units, 3 months. Okay, so that winds this one up, except the instructions now for requesting the quiz should be above my head. Again, subscribers only. And there will be a couple of links to previous exams also above my head right about now. So that's it for this week. If you like us, if you like this, please click the like and please subscribe. All right, thank you. I will see you next Wednesday. Bye.